Hi, you're watching Investor Insights, and in this video I'd like to talk about shorting stocks. Now, in earlier videos I've discussed the concept of going long and going short, and as you know, going long is the easiest thing that anybody can do. You just push the buy button, and when the instrument or the stock that you've bought has gone up in value, you press the sell button, you're out, you bank a profit, and that's how you make money. Well, obviously that's going to work when the market's going up. But what happens when the market's overpriced and you want to either speculate or trade your view that things are going to go down? Well, this is where you have to learn to short stocks. So how it works, it sounds complicated, but it's actually quite simple. You gotta sell a stock at a high price and buy it back when it's low. So the other direction of going long. And how it works in the real world is this. You would go to a broker and he would open you up an account. And this is a special type of an account because in this country you have to be considered to be a professional investor or a high net worth individual. So you got to have at least $250,000 that you can plow into that account, or you must have $250,000 in cash or cash equivalent assets. So after opening this account, then you would have to pick what stock you would like to short. And you would have to find out if, first of all, the stock that you want to short can actually be shorted, because sometimes the regulators, ASIC in this country or the SEC in America, might not let you short some certain stocks, but that's up to their discretion, and most of the time it's just Big Brother trying to manipulate the markets. That's a different video. But today we're gonna short something. So you've gone to your broker and you've selected a stock that, yes, is allowed to be shorted. So the broker then acquires the number of shares that you like to short from either his own firm or from any other organization, whether it be super funds or whoever that's holding the stock. And he or she would borrow those number of shares of that stock from them, and you obviously have to pay them a fee to borrow it. It's normally about $100 or something along those lines, and it's irrespective of the parcel size. So it doesn't matter if you're shorting 1 million shares or 3 shares, it still costs you the same amount to borrow the stock. Right? It's just a transaction fee. Now, what would then happen is the broker then takes the stocks that you don't actually own, that you've borrowed, and sells them on the market at whatever price that you want or that you can get. Now, the money that subsequently comes back is actually obviously not yours, but it's sat in that account and you can't touch it. You can't use it to trade or do anything with it. It's just there. Now, what happens is that the stock hopefully goes down, and when it goes down, you would repurchase the shares and give it back to the broker who returns them to whoever who he borrowed them from. Now, let me give you an example. Say you wanted to short 1,000 shares of company XYZ. So your broker borrows 1,000 shares, and the shares today are worth $50. So he sells the shares that he's borrowed for you at the market price, which is $50. So the proceeds from the sale of those shares is $50,000. Now the share price goes to $25, so it halves, and you decide that it's fallen enough, it's time to go away. So what you do is you instruct the broker to buy 1,000 shares back, because that in theory is how much you actually sold. And upon you buying back those shares, the broker then gives those shares back to whoever loaned it to him or her. Now, if you sold 1,000 shares at $50 and you bought 1,000 shares back at $25, then it means that you've made $25,000 from a falling market. That's a pretty sweet deal. And thus, shorting is a really good form of trade during times of falling markets, or when you're really in the know and you're a real clever person and you've worked out through seeing companies showing many warning signs that things are about to fall apart. It's fantastic. Short the life out of it. Now, shorting has its downsides. And in fact, shorting should only be done by the professional or those who are advanced enough to understand all the risks associated with shorting. Now, when you go long a stock, your loss potential is the amount that you put in. So if you bought 1,000 shares at $1, your loss potential is that $1,000. If the stock goes to naught, you've lost $1,000. When you short a stock, your loss potential is infinite. So if you short 1,000 shares at $1 and the shares go to $10, you've actually lost $9,000. If the stock goes to $100, then you've lost $99,000. These are big dollars. These are big bucks. Your loss potential when you short something can be too much to bear. Normally, in a margin account, you have to put in more capital should the position move against you. The capital being called margin. Now, if, for argument's sake, the share moves 10% and most of the shorting or margin accounts would ask you to normally put in 20%, and if you're getting near that 10% or 15% buffer, they might ask you to put in, you might get a margin call and you might be asked to supplement the account with some more cash, some more margin. Now, there was recently I shouldn't say recently, this was going back 2 or 3 years, where a German billionaire had to commit suicide because he was shorting Porsche stock. And this happened to be the biggest short squeeze in the history of mankind, where the stock went from, I think, $25 to $1,000, and he lost all his money. So he jumped in front of a train. A short squeeze is when you have a lot of buyers out there and not enough stock, so they just keep on chasing this stock up and up and up, and you've got people who are short who got to buy back the shares or cover their positions, and they're chasing the same thing. And what happened was Volkswagen was going to take over Porsche, or Porsche was going to take over Volkswagen. One of the two, doesn't matter. The gist of it is the stock went from 25 to 1,000 in 1 hour, and it went straight back to 25 or 30. That wasn't the point, but it's the fact that the position moved so much that it's been deemed to be the biggest short squeeze in history. And it cost this, I think it was a 73-year-old German billionaire his life, because he just lost his whole fortune shorting a stock. So shorting a stock has got many advantages, especially in falling markets, or dealing with stocks that are shonky companies to begin with, but it's a perilous act, and it's fraught with danger and should only be looked at by the professional. Another point to keep in mind is that the richest people in the world are long-term investors. There is no such thing as a person who gets rich from shorting stocks. Yes, there may be the one or two lucky person who struck gold on a stock, i.e. Jim Chanos with Enron, where he shorted this thing from $70 to naught and made a fortune out of it. But the thing is, that was his only profitable trade. Warren Buffett's been buying hundreds of companies throughout his life, and he's never even shorted a stock, and he's the world's richest investor. So as I always say, if it's good enough for him, it should be good enough for you, in terms of his investment philosophy, not what he does, not every trade that he sets out to accomplish. But shorting stocks has its many advantages, and it also has many frightful disadvantages.